Here's what they won't tell you about dividend investing. The financial media wants you to believe you need $2.5 million to earn just $5,000 a month in passive income. But I'm about to show you the math that proves they're either lying, or they simply don't know what's actually available to everyday investors. Because while Procter Gamble and Coca-Cola get all the attention on CNBC, there's an entire category of investments paying 3x, 4x, even 5 times higher yields that nobody talks about. And by the end of this video, you're going to see exactly how much you actually need to generate real income from dividends. Let's get into it. The most attractive thing about dividend investing? Living entirely off passive income. You don't have to sell shares when the market drops. You don't have to time your exits. You just collect checks, month after month, quarter after quarter, no matter what's happening in the market. It's the retirement dream. But here's where most people hit a wall. They start asking the right question. Okay, if I want $5,000 a month in dividends, how much money do I actually need invested? And there's a simple formula to answer this. It looks like this. Investment amount needed equals desired monthly income times 12, divided by annual dividend yield. So for $5,000 a month, that's $60,000 per year in dividend income. The question becomes, what yield are you using? And this is where the mainstream financial advice completely fails you. Let me show you what happens when you follow conventional wisdom. When most people think dividend stocks, they think consumer staples. The blue-chip darlings that everyone knows. Procter & Gamble. They've been around since 1837. They make Tide, Pampers, Gillette, Crest, brands that are in virtually every American household. According to their most recent data from December 2025, Procter & Gamble currently yields 2.96%. Now watch what happens when we plug that into our formula. $60,000 divided by 0.0296 equals $2,027,027. You need just over $2 million invested in Procter & Gamble stock to earn $5,000 a month. And here's the devastating reality check. According to the 2023 Federal Reserve Survey of Consumer Finances, the most recent data available, the median retirement savings for Americans aged 65 to 74 is just $200,000. Not $2.3 million. $200,000. That means the typical American near retirement age would need to save 11 times more than they currently have, just to follow the advice that CNBC gives every single day. And it gets worse. According to a 2024 AARP survey, 20% of Americans over age 50 have zero retirement savings. Nothing. A separate Gallup poll from April 2025 found that only 60% of all American adults have any money in a retirement account like a 401k or IRA. So when someone with $50,000 saved, or even $100,000, tries to calculate how they could live off dividends using mainstream stocks, the math is soul-crushing. Want $4,000 a month at a 2.59% yield? You need $1.8 million. Want $3,000 a month? Still need $1.4 million. Even just $2,000 a month requires over $1 million. This is why so many people give up on dividend investing altogether. They think, if I'm not already wealthy, this strategy isn't for me. But that's not the full story. Because here's what they're not telling you on Fox Business or in Barron's magazine. The consumer staple stocks that get 90% of the media coverage represent less than 10% of what's actually available to income investors. There are entire asset classes, REITs, business development companies, covered call funds, that offer dramatically higher yields. And they're just as accessible to regular investors as Coca-Cola or Procter & Gamble. But you almost never hear about them in mainstream financial media. So let me show you what changes when you start looking at what actually exists. Let's start with probably the most well-known higher-yielding category: real estate investment trusts, or REITs. These are companies that own income-producing real estate, office buildings, shopping centers, warehouses, apartment complexes. They're required by law to pass at least 90% of their taxable income to shareholders as dividends. Take Realty Income Corporation, ticker O. It's one of the most popular REITs in America. As of December 2025, it currently yields 5.61%. Now watch what happens to our numbers. To earn $5,000 a month, you need $1,068,000. For $4,000 a month, you need $854,000. For $3,000 a month, it comes $641,000. And for $2,000 a month, you'd need at least $427,000. Already, we've cut the required investment almost in half compared to Procter & Gamble. But we're just getting started. Now let's look at an investment category that most mainstream media completely ignores. Business development companies, or BDCs. These are publicly traded companies that provide financing to small and mid-sized American businesses. They operate under similar tax rules as REITs. They must distribute at least 90% of their taxable income to shareholders. The largest and most well-known BDC is Ares Capital Corporation, ticker ARCC. As of December 2025, Ares Capital yields 9.45%. Let me show you what this does to the math. To earn $5,000 a month, $652,000. For $4,000 a month, you'd need $522,000. For $3,000 a month, that amount comes down to $391,000. And for $2,000 a month, it's $261,000. We've now cut the investment requirement by nearly 70% compared to Procter & Gamble. But there's one more category that takes this even further. This is where it gets really interesting. Covered call ETFs. These asset classes use an option strategy to generate income. They hold a portfolio of stocks, often tracking major indexes like the Nasdaq 100 or S&P 500, and then systematically sell call options against those holdings. Those option premiums become income that gets distributed to shareholders, usually monthly. One of the best-performing covered call ETFs is QQQI, the NEOS Nasdaq 100 High Income ETF. According to the most recent data from December 2025, QQQI has maintained a distribution yield of 13.7%. Look at what happens now. To earn $5,000 a month, you'd need $438,000. For $4,000 a month, $350,000. For $3,000 a month, it will be $263,000. And for $2,000 a month, it's $175,000. We're now talking about less than 1/4 of the capital requirement compared to investing in Procter & Gamble or Coca-Cola. And yes, I know, saying you only need $175,000 still sounds like a lot of money. But compare that to needing $2.3 million. That's the difference between achievable and impossible for most Americans. Now, we need to talk about risk and sustainability. You know you should never put all your money into a single investment. Diversification across multiple stocks, funds, and sectors is essential. And here's the question everyone needs to ask. How high of a yield can you safely go? The answer depends on the investment type. For a REIT, an 8 to 9% yield would be considered very high and potentially risky. But for a BDC, that's completely normal and sustainable. What I found after years of researching high-yield investments is this. Once you get above 14 to 15%, you start entering territory where consistency becomes a real problem. Take CLO funds, collateralized loan obligation funds. These can offer yields well above 15%, but if you look at their actual dividend histories, you'll find inconsistent payouts that jump around from quarter to quarter. Then there's synthetic covered call funds, which can push yields even higher. But these strategies often come with significant NAV erosion, meaning the share price erodes over time to fund those distributions. The investments I covered earlier, REITs yielding 5 to 6%, BDCs at 8 to 9%, and well-managed covered call ETFs at 13 to 14%, these tend to offer much more reliable income streams. Many actually increase their distributions over time, which means your income can grow even if you're not reinvesting. Let me give you some concrete examples of this reliability. Realty Income has increased its dividend 133 consecutive times since going public. They literally call themselves the monthly dividend company. Ares Capital has maintained its dividend through multiple market cycles, including the 2008 financial crisis and the 2020 pandemic crash. Their Q3 2025 earnings showed net investment income of 48 cents per share, perfectly covering their quarterly dividend of 48 cents. And QQQI. In a recent Seeking Alpha analysis from November 2025, analysts noted that unlike many covered call ETFs, QQQI has actually grown its net asset value while maintaining high distributions. It captured 98% of the Nasdaq 100's returns in the previous 12 months while generating that 13 to 14% income. These aren't speculative plays. These are established strategies with track records. Look, I'm not going to sit here and tell you that everyone watching this video is going to retire wealthy. That wouldn't be honest. But what I will tell you is this. If your dream is to live off dividend income, it's not reserved only for people who already have millions of dollars. The path exists. The investments exist. The yields exist. According to the latest Federal Reserve data from May 2025, 35% of non-retired Americans feel their retirement savings are on track. That means 65% don't feel prepared. But here's what most people don't realize. It's not that they can't save enough, it's that they're aiming at the wrong targets. When financial advisors run the numbers using 2 to 3% yields from traditional dividend aristocrats, they're setting you up to believe you need impossible amounts of money. But when you understand that you can construct a diversified portfolio yielding 7%, 8%, or even 10%, suddenly the math becomes achievable. A $300,000 portfolio at a 10% yield generates $30,000 a year. That's $2,500 a month. Is $300,000 easy to save? No. But it's a hell of a lot more achievable than $2 million. The mainstream financial media keeps pushing the same 20 stocks because that's what their sponsors want them to talk about. But the entire world of high-yield investing, REITs, BDCs, covered call strategies, gets almost zero coverage. That's exactly why this channel exists. If you want to learn more about these alternative income investments that actually move the needle for regular investors, then subscribe to this channel. Thanks for watching, and I'll see you in the next one.